All right, folks, we're going to talk insurance. I'm going to go a little bit faster. I did the TikTok earlier, and um, the took me a little bit longer, and so I was trying to upload the file, and it was having issues. So I'm re-recording this, and so when I get to definitions, we're going to be doing a handful of definitions today. So when I get to definitions, okay, I'm just gonna give you the definition one time. You guys have the ability to pause and write down that definition, rewind if you need to rewind, okay? But I'm gonna go a little bit quicker so that I can have a smaller file to upload on YouTube. So first definition that I want to cover with you, we're gonna be talking about insurance, okay? So we're going to define insurance. So here is the definition that I want you to write in your notes for insurance. Insurance is the transfer of risk of financial loss. Okay? Again, insurance is the transfer of risk of financial loss. And that's the definition I want you to write in your notes. All right? So let's talk a little bit about insurance. All right? Analogy that I like to use is I like to say, okay, think about the definition that I just gave you, the transfer risk of financial loss. And then most of you are probably somewhat familiar with auto insurance. So let's say that you have an auto insurance policy. What risk are you transferring? Okay. Now, the most common answer that I get is, well, you're transferring the risk of getting in a car accident. Okay? Now, it's a little bit of a trick question, and here's why. The answer is no. No amount of insurance is going to help prevent you from getting in a car accident. When you get in a car and you drive, you are taking a risk that you may end up in an automobile accident. So if you have, a ton of insurance, that's not going to help you not get in the accident. Okay? So what risk is insurance transferring? The definition says it's transferring the risk of financial loss. That's the risk you are transferring. So if you do get in that auto accident, okay, the financial loss that you are going to experience will be covered by the insurance company. And so you're transferring the risk of financial loss to the insurance company. So if you total the car and you have to replace the car, the insurance company will pay for a good chunk of that. Okay? If there's injuries and you end up in the hospital and you have hospital bills, the insurance company should pay a good chunk of that. Okay? And so it's the financial loss is the risk that you are transferring to the insurance company. Okay? So insurance is all about risk. And so we're looking at the risk of you getting in an automobile accident. Now, if the risk is high, then you're going to get in an auto accident because you're a teenager. Sorry, guys. But what's going to happen to your premiums? Well, your premiums are going to go up. That's the next term that I want to define with you. Premium. Okay? Write down the word premium. Here's the definition that I want you to write down for premium. Premium is the amount the customer pays for insurance coverage. Okay? Premium is the amount the customer pays for insurance coverage. So you pay a premium to the insurance company, and then the insurance company then provides you with financial protection if something were to happen. Okay? If you are a poor driver, you've got lots of speeding tickets, you've got lots of accidents, your premium will go up because you are a greater risk to the insurance company. Okay? They look at data, they look at the statistics, and they base your premiums off of that. If you have an expensive car, what's going to be the cost of your insurance premium? It's going to be higher than if you have a cheaper, inexpensive car. Okay? And so they're looking at a number of factors. One of the things I like to say about insurance companies is that they do numbers as well as, if not better than Vegas. When you go to Vegas and you gamble, the odds are in their favor. The casino wins most of the time. Okay? They know what the odds are of you winning, and they know what the odds are of you losing. And you lose more than you win when when you go gamble in Vegas, okay? So insurance companies, they also know those numbers. They've crunched the numbers and they know, hey, this is the likelihood that this demographic is going to get in an auto accident, okay? And this is the average cost per claim, okay? And one of the things that I like to tease, if we're sitting here in the classroom, you know, we'll ask, okay, who costs more money to insure, teenage boys or teenage girls? And most of you know that. Most of you know, it's teenage boys. And then I say, all right, well then who gets in more accidents, teenage boys or teenage girls? Oh, well actually teenage girls get in more accidents than teenage boys. Well then why do teenage boys cost more? Well, because their cost per claim is significantly higher than teenage girls. Girls get in a lot more fender benders, and guys get in a lot more total the car and injure people in the process of doing it. So the amount that the boys are costing when they get in those auto accidents is significantly higher than the girls, and that's why their insurance premiums are higher. Okay, so the insurance companies are looking at the risk that they take when they insure you. Okay. Another term that I want you to know is deductible, okay? The definition I want you to write down for deductible is the amount the customer pays before the insurance coverage kicks in, okay? And I'm going to show you here on the board kind of how a deductible works, okay? But let's say that you are, driving down the road and a truck flips up a rock and that rock hits your windshield and it breaks your windshield, okay? If you have a $500 deductible on your insurance policy, okay, and the cost to fix that window is going to be $300, are you going to file a claim on your insurance policy? And the answer is no. Why not? Well, because $500 is the amount the customer has to pay before the insurance coverage kicks in, and the cost of fixing that window is not even, it's $300. It's not even $500 that it's going to cost, okay? And so deductible, again, is the amount the customer has to pay before the insurance coverage kicks in, okay? So now let's say that you're driving down the road and let's say that you have an accident, okay? And it's going to cost $5,000 to fix your car, okay? Are you going to file a claim now? Well, of course, that's why you have the insurance in place. You're going to pay that $500 deductible. That will happen first. So you pay $500, and then the insurance company, depending on what your coverage amounts are, but they should cover the rest, okay? So the deductible is the amount the customer pays before the insurance coverage kicks in, okay? I do want you to understand that with insurance, if you're filing a lot of claims, it will impact your premiums, okay? And so if you, that's why you'll hear these commercials of, hey, if you have no claims and you file one claim, your premiums aren't going to go up. And there's insurance companies that will advertise that your first claim, the premiums don't go up. Well, if there's more claims after that, well, your premiums are probably going to go up, okay? And so, they're looking at, are you having more accidents than the average person, or are you a safe driver, okay? So that's what a deductible is on your insurance policy. Now, I want you to think about this because we've talked rich and able all year long, right? Biggest difference between rich and able is that rich saves money, right? Well, think about this. If you have a policy, okay, and let's erase this part. And now, as a customer, you get to choose what your deductible is on your policy. So if you have a choice between a $250 deductible and a $1,000 deductible, okay, well, you may be thinking, well, I'm going to take that $250 because then if I get in an accident, I only have to pay $250 towards the cost of that accident. Right. But what's going to go up as a result of that? Your premiums, okay? If you choose a lower deductible, your premiums are gonna go up, okay? Because you're passing more of the risk of that, you know, paying for that accident onto the insurance company. If you choose $1,000 deductible, instead of a $250 deductible, your premiums are going to come down. And so you're gonna look at it, and you're gonna weigh what's the cost of going with a higher deductible on this plan. And if you are rich and you save money, you can easily pay a $1,000 deductible. That's not gonna be a huge financial burden to you if an accident were to occur, okay? And so, you know, if you have saved money, you can easily afford to go with a higher deductible amount, and that's gonna save you money each month on your premiums. And if you wanna get real technical, you could take that savings and put it towards saving more money to meet a deductible if you were to have to do that, okay? So that is the idea and the concept of a deductible, okay? A couple more terms that I want you to know about, okay? We're gonna talk about coinsurance, okay? Coinsurance, the definition I want you to write down for coinsurance is the customer and the insurance company share in the cost of a claim, okay? So the customer and the insurance company share in the cost of a claim, all right? So here's what happens, okay? Let's say that on a policy, you have a deductible of $1,000. Now coinsurance, it's going to be something like 80-20, okay? So you have 80-20 coinsurance. What that means is that the insurance company is going to cover 80% and you're going to pay for 20%. Okay, so if you go in, you have surgery, and this would be a nice cheap surgery, okay, but I'm just doing it for the sake of numbers, but you had a surgery that cost $6,000. The first thing you're going to have to do is you're going to have to meet the deductible on that. Okay, so you pay that $1,000 and the remaining balance is $5,000, right? So now there's 80-20 coinsurance on that, okay? So the insurance company is going to pay 80%, you're going to pay 20% of that remaining balance. So 80% is going to be $4,000, and that's what the insurance company is going to pay, and you're going to pay an additional $1,000. So you paid, out of that $6,000, you paid $2,000. You paid $1,000 for the deductible, and then your share or your co-insurance amount of 20% was another $1,000. Okay, insurance company paid $4,000. All right. So again, if you have 80-20 co-insurance, okay, versus 50-50 co-insurance, okay, 50-50, you're going to pay 50, the insurance company is going to pay 50, okay? Which one's going to have lower premiums? Well, 50-50 is going to have lower premiums because in this situation, the insurance company is going to pay more money out of their pocket for medical claims, okay? All right, so that is the idea of coinsurance. One more term that I want you to write down is copay, okay? A copay, just C-O-P-A-Y, copay. A copay is the amount that you pay for a routine doctor visit, okay? So if you have a $25 copay, what that means is when you go into the doctor, you're going to pay $25 for that doctor visit. Now you'll sometimes see, you know, when they're quoting insurance, you'll see like 25/50. And what that means is that this is what you would pay for your routine doctor visit with your primary care physician. This is what you would pay if you go to see a specialist, okay? And so this is the copay for your primary care physician. This is the copay for your specialist. So I would anticipate that a handful of you have been to the doctor and you walk in and they say, what's your copay? And hopefully your parents have told you what your copay amount is, okay? But you're gonna make a copay when you go for a routine doctor visit, okay? And the reason why it's copay is because you're paying a set dollar amount. I want to make sure I define copay. Here's the definition I want you to write down. Copay is a set dollar amount you pay for a doctor visit, okay? So it's a set dollar amount that you pay for a doctor visit, okay? So in this case, that set dollar amount would be $25. In this case, if you saw a specialist, it would be $50, okay? And the reason they call it copay is because that's not the full cost of that visit. You're paying that amount, the insurance company is paying the rest. So again, you and the insurance company are sharing in the cost of paying for that doctor visit, okay? One more word that I want you to understand is liability, okay? Liability refers to who is responsible, basically, okay? So the definition that you can write down for liability is the person responsible for an accident and a claim, okay? And so, you know, I like to use the example, I got a projector right here. If that projector were to fall and hit a student, okay, who would be liable for that? Could I be liable for that? Yeah, I potentially could be, because if I didn't identify that it wasn't installed correctly and safely and it falls down and hits somebody, I could be held responsible for that, okay? So I might be liable, okay? Would, you know, the person who installed it be liable? Well, yeah, if they didn't install it the right way and they didn't follow the directions of the way, you know, what was supposed to happen, they could be liable. Could the school or the district be held liable? Yeah, if they didn't train people to install those in the right way and they didn't provide, you know, the instructions of how to do it, they could be held liable, okay? And so you're looking, liability is like, who's responsible for that? So if there's an auto accident, liability refers to, well, who's liable for it? Who's responsible for it, okay? You know, I had a situation recently where we had a parked car. We were inside in the building and somebody hit our parked car, right? Well, who's liable for that? Well, they are. The car was parked, okay? And it's like, if you hit a parked car, you're gonna be responsible. You're liable, okay? And so oftentimes you'll still file a claim with your insurance company. They'll file a claim, and then my insurance company would go after their insurance company to collect from them. Okay, when you get in an accident, that's why you exchange insurance information. It's something that you should do, is because, you know, you have their insurance information, they have yours. If it was their fault, their insurance company should pay for it, okay, ultimately. So, so liability is the other term that I want you to write down, okay? So those are just some basic concepts about insurance, okay? Next time, Wednesday's lecture, we're going to get deeper into health insurance. And we're going to kind of look and break down health insurance and how that works. It's kind of a fun one, gets a little bit political. It's a hot political topic in our country right now, health insurance is. And so, but there's just the basics for you of just insurance generally. We're going to look at 4 different types of insurance, okay? This one's not on the quiz, but we're going to look at auto insurance, health insurance, life insurance, and homeowners insurance, okay? There are lots of other types of insurance, but those are the 4 that we're going to look at in this class, okay? So, thanks for tuning in. Hope you guys are doing well. Hope you're keeping safe and healthy, all right?